The third ratio as part of the activity ratio is known as suppliers payment terms. I am sure friends we can very easily understand as in principle for managing our working capital well. On one hand we have to keep our inventories low. On the second front we have to keep our receivables also low. On the third front, what we need to do, we need to negotiate longer credit terms from our suppliers. Why? Because longer credit term that I get from my supplier, longer I am able to use suppliers' money in my operations. And in principle, in business, it is always good to do the business with the capital of others rather than putting your own capital. So, third ratio that we calculate as part of the activity ratio is known as suppliers payment terms or payment terms in number of days. How do we calculate this ratio? Take the figure of accounts payable. So that means at any given point in time, the amount of goods that you have purchased on credit will constitute the amount of accounts payable. Accounts payable divided by cost of goods sold or cost of sales, right? So when you divide the amount accounts payable by the amount of cost of goods sold or cost of sales, multiplied with 365, and what you get is DPO. DPO is days payable outstanding. Days payable outstanding. Longer it is, better it is for the business. But remember, how should it be longer? It should not be longer because we are not paying to suppliers on time. It should be longer because we are able to negotiate longer credit period terms from them, and that's your suppliers payment terms or the DPO, that is days payable outstanding. Now, having done this, we come to the fourth category of the ratios, financial ratios for the financial analysis, and that is known as leverage ratio. Now, before I come to the fourth category, that is leverage ratio, in case if any one of you have any question, please go ahead and I'll take your question and then we'll go to the next.